and welcome. This is the Studio Stack podcast. Each week we go behind the scenes and talk to industry leaders about what it takes to build, join, and invest in startup studios. I am your host, Deanna Lesage, and this podcast is your Startup Studio Masterclass. Today on the show, we have Shilpa Kannan and Mitchel Peterman, co-authors of the new book, Venture Studios Demystified. Shilpa is the co-author of Venture Studios Demystified, and after spending the early part of her career in private equity investing, she began working with venture capital firms and their portfolio companies, helping founders find product market fit and scale successfully. She came across the venture studio concept during her time at Stanford University Graduate School of Business and was drawn to this novel approach to entrepreneurship. Shilpa is now lending her brilliance to Amazon as a product manager. In the future, she hopes to combine her investor's mindset with this product background to start her own venture studio. Mitchel Peterman has a background in operations and has worked with several impact-driven startups as he is very passionate about improving opportunities for underserved populations. As an undergrad, Mitchel studied economics and journalism at Northwestern and went on to earn his MBA from Stanford Graduate School of Business. And during his time at Stanford, he came across the venture studio model and joined Menlo Ventures to help pioneer their venture studio arm, Menlo Labs. His interest lies at the intersection of the studio model and its potential to create disruptive innovation in the social impact space. He's currently pursuing a master's degree at the prestigious Harvard Kennedy School of Government. Together, this dynamic duo spent a year working with 20 studio leaders across the world on a mission to codify the venture studio playbook and break down everything from why studios launch, how the ideation process works, where the capital comes from, and shed light on the legal and financial structures of the model as well. I am so excited to have these two brilliant innovators here on the show today. Without further ado, let's jump in. Hello, Shilpa and Mitchel. Thank you for joining the Studio Stack podcast. I'm so excited to chat with you today about your new book, Venture Studios Demystified, How Venture Studios Turn the Elusive Art of Entrepreneurship into Repeatable Success. I love that title. This is like the Bible for the startup studio community. I read it cover to cover a few times now, and it's got raving reviews from the studio community. So I cannot wait to dive in with you both. Welcome to the show. Thank you for being here.
Thanks so much for having us.
Thank you.
Awesome. So let's just get started because we only have 30 minutes and we have a lot of ground to cover. First question for each of you. Shilpa, we'll start with you. What is your definition of a startup studio?
In my opinion, a startup studio is an organization that builds startups in a systematic way. So they're involved from ideation, validation, MVP, all the way to funding. So I think of a studio almost like a co-founder.
Awesome. Mitchel, how about yourself?
I think Shilpa and I are pretty aligned. I mean, I think studios are entities that design and build companies in a repeatable fashion, like Shilpa said. I think they often bring together researchers, designers, engineers, business people. They sort of coalesce a team to build new businesses from the ground up. And I also sort of think a differentiating definition of a studio is operations as a founder / co-founder, as opposed to a secondary investor or sort of support mechanism for already established founders.
That is great. That's a great response. And I think I would definitely align with both of those definitions. Let's talk a little bit about the book and just the motivation for writing the book in general. How about Mitchel? Tell me a little bit about where the idea came from, and we can talk through the book in detail in a minute.
So Shilpa and I were actually both classmates at the Stanford Graduate School of Business. In between our first year and our second year of business school, we both worked at venture studios. And we both became really fascinated by the space and the concept and sort of this new way to build startups. But we left those experiences with probably just as many questions as we did answers. So we kind of wanted to figure out, okay, how successful are venture studios as a group? Actually, we started a class project with some of our professors to sort of dig into the financial and operational aspects of studios and figure out, okay, how does this asset class compare to venture capital? How successful is it? Is this a space that we want to enter when we graduate? And kind of at the outset, we wanted to compare returns data. We wanted to figure out what aspects of the development process made the most impact into building successful ventures. But the more we talked to different partners at different studios, the more we kind of got a sense that they were getting the same questions over and over from people looking to enter the space, just about how do I structure my studio? Where do I fundraise? How much do I need to fundraise? How do I set up an ideation process? And so we sort of broadened our project to take a little bit of a bigger scope, um, and try and answer those common questions that a lot of other new entrants into the space were asking, and consolidate it into what ended up being a book format, so that anyone who's looking to invest in studios, anyone who's looking to build a studio, anyone who is looking to maybe join a studio as an EIR would have sort of this one-stop shop resource to answer a lot of their initial questions and get a really good, solid foundational overview of what are venture studios and how are they growing.
Yeah, I think that's really a necessary component in the studio space. There is a foundation that's kind of been laid, and even though it's a relatively new field, there's definitely been a lot of work that's been done to standardize some things. So I love that, and as the kind of motivation. Shilpa, how eager or open were studios to talking to you about some of their processes? In general, did you find that as a challenge?
Not at all. I think because the space is so new, everyone is learning together, and so we were really happy with how open studio leaders were to talk to us. Obviously, some studios are super busy, and we couldn't get in touch, but pretty much across the board, whenever we reached out, they were open to chatting. And you heard what Mitchell said. I mean, we asked questions that ran the gamut from like, how much did you fundraise when you were starting out, to like, what is your process, what are your gates, and what is the success that you've seen. We were really getting into the nitty gritty, and we're super thrilled that everyone was open to sharing. I think where the space is now, everyone wants to grow. They want to grow together. They want to grow the brand of studios because it's so new, and not everyone understands how it works. And so that's why I think when we were talking to them, there's a lot of enthusiasm to share the learnings and be open to those who are coming into the space.
That's a great point, and I'd be curious to hear one or two things that surprised each of you the most. Like what, because you had some idea of how venture studios worked going into it. You had both worked at and kind of been around studios. So, what surprised you about what you learned? And we can maybe start with Mitchell on that one.
Yeah, I mean, I think what surprised me the most is just like everybody is still trying to figure this thing out. Like, there is not a set right way of doing this. Um, there's different approaches you can take to almost every single aspect of the venture studio process. And because it's such a new asset class, um, even some of the most established or what people would look to as being the most successful current venture studios, we would talk to partners and they were like, hey, listen, we're still trying this and we're still trying that and we're still not necessarily sure if this is the right way to be doing it, and we're talking to other studio partners as well to figure out what is the best way that we can be adapting and changing in order to create better startups. And so I think generally you're getting this situation where like everybody's trying to figure it out, but they're trying to do it together, which is uh, really good to see out of the ecosystem. And I think that goes back to Shilpa's point about people just being willing to talk and share very openly about what is working and what is not. And the other thing that I think I found very surprising is just the general similarity in the overall process. So I didn't see a ton of radical difference in terms of like the approach to how to build a business. There's nuanced differences in terms of what do we focus on, or how much do we invest when, and do we bring on EIRs now versus later. Um, but the studio approach, or sort of the methodology of, okay, how do we build a startup from 0 to 1, seems to be at a high level relatively consistent across sectors and across different studios.
Yeah, I mean, from my own experience, I would say that sounds right. And I also think that would be surprising. Like you would think there would be some kind of secret sauce innovation process, that each studio has to differentiate themselves from each other. But I think you're right in that it's largely kind of the same. Shilpa, how about you? What were one of the two things that was really surprising that you learned from doing the whole process and research?
Yeah, I'll plus one to what Mitch said about kind of seeing a standardized process of using design thinking and fail fast methodology to build companies. I think what surprised me was that capital was so important. I mean, with any business, of course, you need money. But I think what we found is that the ability to access patient capital really makes a difference for how many companies you can start, how fast you can move, like whether you have to pay attention to revenue, all of these things that are really important, like having capital matters a ton. And so that was something that is, I guess, seems obvious in hindsight, but the importance of it and the disparate access based on your background, your experience was something that was surprising. And I think the second thing I'll probably say is kind of going off what Mitch said about how studios are still figuring out the specifically like how studios find ideas or generate ideas had such variance across everyone we spoke with. Even if you have EIR programs, like there's so many different flavors of what that could look like, who you recruit from. And so it really just was interesting to see how much that differed. I think Mitch and I, we did work with individual studios before, but seeing it across like the board in terms of our interviews, it was just clear how generating ideas is so important, and tapping into different sources, whether hiring an EIR, having one ad hoc, or having an internal team dedicated to it, is a really critical part of the model.
Yes, and double tapping on that kind of source of ideas. In your research, did you find that most studios had a mix of internal and external ideas, or did most studios come up with ideas on their own? Did most studios only work with entrepreneurs outside their studio? Like, what did you learn in that domain?
Yeah, and I think this is another interesting aspect of the studio model, because conceptually, a studio is designed to be a founder or a co-founder. It is an entity that is building startups from 0 to 1. Now, in practice, what we actually found was a lot of studios, and especially earlier studios, there was this conflict between, do we accelerate external ideas that are coming in because we have not yet developed a really robust in-house ideation capacity? We're seeing either partners or colleagues of the partners of the venture studio getting inbound, hey, my friend is working on this venture. We think this is really interesting. You might be able to help support it. Or, hey, here's a new product that is being launched. We think you'd be able to provide XYZ services to launch it. And that is not necessarily the definition of a studio in the way that a lot of people might think about it, right? Like, that is not coming up with the idea in-house and developing it. That is accelerating an external idea. But for a lot of early studios, that works really well because they're able to do that. They're able to provide a lot of hands-on support. They're able to operate sort of still in a co-founder capacity, but one that comes on a little bit later. And then while they are helping to scale and develop some of those external ideas, they're simultaneously developing in-house capacity to build their own ideas. And so that true in-house ideation that maybe a lot of us think about studios as being, I think we found often comes a little bit later in the maturity cycle of a studio's development process. So I thought that that was pretty interesting in terms of the mix of where ideas are coming from, and just sort of this constant conflict of, we're operating in a venture ecosystem where there's a lot of entrepreneurs and ideas around us, but we're also supposed to be building our own companies internally, and we have limited resources. How do we split that between strictly adhering to this concept of, no, we build our own ideas, or, you know what, we build our own ideas, but sometimes if we like an entrepreneur that already has an idea, or we like a company that already exists and we want to scale it, we bring that in and apply resources there. So there's kind of like this, it's still a gray area, right? Like, this whole asset class is emerging, and I think a lot of the studios and the partners that we talk to, we're still trying to figure out, how do we balance this external versus internal.
I agree with that. Shilpa, did you?
Yeah, sorry. I was just going to add on a little. I think, regardless of how studios take, like which approach they take in terms of getting the ideas, I think one thing we heard across the board was bringing on the founder as early as possible is really important, because that the founder is critical for the success of the company, like any startup. And so even studios that had internal teams like running at ideas, coming up with them, still were really emphatic that bringing on the founder early was critical to success. And I think the other thing I will say is, part of what Mitch, I think, was talking about is having the top of funnel maintained and vibrant, and a large volume of ideas at the top of the funnel is really important, because you see it winnow down quite substantially from the ideation stage to actually getting to MVP. And so part of I think what we were seeing of using EIRs or an internal team or a mix of both was because you just need a high volume of ideas at the top, even to just get one company through. It could be anywhere from 20 to 100 ideas that you need to start with to get to an end one that is launched.
Yeah, definitely. And I think what happens when you have, many ideas is there's a little bit of a monetary issue. Like, how would we test all of these ideas? You need many at the top, but you have to choose which ones you're going to basically invest in. And it's not huge, hundreds of thousands of dollars, but $3,000 to run an ad campaign or to test something right off the bat times 12 ideas starts to get very expensive. So that's kind of one of the areas that I wanted to dive into a little bit. In the book, you kind of read about the expenses of company building and exits being the main revenue generation. But then you kind of go on to correctly point out that exits from studio born ventures take years to materialize, like from back of the napkin sketch to having an exit where it's an acquisition or a merger or something else, I guess an IPO, like not Dollar Shave Club, that is Hims, IPO'd, and I think it was like some incredible amount of time, like 12 months or something. But regardless, you need funding to do these kinds of things. And to your point that you pointed out earlier, Shilpa. So can you talk about some of the ways that you found in your research that studios are filling that gap? Like how else, what is the studio sustainability revenue model generation? What are some of the ideas that you saw in your research?
Yeah, I mean, sustainability is a huge challenge. Multiple times with studio leaders, they would talk about how they're really focused on just extending the runway of the capital they've raised. So, definitely, I mean, studio exits, we found it varies, of course, by studio, but takes 10 plus years to materialize often. One lever that studios can flex is when they actually exit their company. So, what you're talking about with like an IPO, those have usually very large time horizons. But something a few studios had done, it's pretty rare, but start to exit by a secondary. So they sell much earlier than when the company exits and they get some liquidity early and then can build upon that success. That's usually something that we saw for like very early stage studios because they might have trouble raising a bunch of capital up front. They can do a couple quick exits and then start kind of building their repertoire. It's not a super common method, I think, because it's probably very hard to leave money on the table, especially when you founded that company. But it was a really useful lever that we talk about in the book. And now, aside from that, there are a couple other ways that we noticed studios focus on generating revenue. The three that we talk about is billing back, corporate co-builds, and corporate consulting. So billing back is basically just charging the company that you launch for some of the services that you provide. Some studios start from the very beginning of when they actually started the idea, but I would say most studios tend to do it after the company is spun out and separate. And so they then just, it's almost like you're providing services like talent, you're helping them with hiring, you should be paid back for it. This is not a way to generate profit. It's more just recouping the costs of support. But that can be a really effective way to get some of your costs back. Because of what we talked about with the funnel, you're obviously not getting all of it. You're going to have to invest more for the earlier companies than you get back, but it can help bridge that gap. Now, the two other methods are working with corporates, and I'd say this has its own challenges because it can distract away from the core studio operations, particularly corporate consulting. And we saw that much more with studios that started out in the product development kind of background where they have that expertise and they can work with corporations on innovation and developing products. But it certainly is separate from what a studio does, and it can detract from team time in launching companies. The margins are pretty good. You can get up to like 40% margins is what we saw. So if a studio is really challenged to generate the capital, corporate consulting can be helpful. The last one is corporate co-builds. I think this is a super interesting way to generate revenue. So you're basically partnering with a corporate and co-founding a company together. The benefit to the studio is you get to charge not only for your services, so they often charge their services at a margin, but then you also get founders equity, similar to what you would for any company. So you kind of get like two financial benefits there. I guess the second thing I'd say is there aren't that many examples yet, but one that we came across was PSL launched a corporate kind of co-build program with Fortive, and they've had some successes already where Fortive acquired the company. That was when we saw publicly. And so that can happen in a corporate co-build where the corporate partner is your route to exit. So you almost, if the company goes well, you have guaranteed capital to exit. That's amazing. The challenge is if that doesn't happen or the corporation, may pause you from launching because they have different incentives or are scared, it's just like managing a different partnership. So those are, I'd say, like the key ways that we saw studios generate money. When you do that, you can really bring down the amount of capital you have to raise. We talk about it in the book in terms of the cases, and you can play around with the numbers, but you could almost be self-sustaining depending on which mix you choose.
Yeah, absolutely. I think, obviously working with corporates route is attractive. There are challenges at some that you pointed out. Also, I mean, it's the timetable is long. A lot of times the legalities of things are complicated and require lawyers and people to be involved. So it's very much not, it's kind of like building a startup, but it's also kind of like working with a giant, collaboration, oh my goodness, a giant business. So, yeah, I think those are definitely really great strategies though. And when you kind of spoke on fundraising, and these studio sustainability methods as a way to, supplement and support the fundraising efforts. What did you learn about studio fundraising? Like that is like kind of the number one question that I get all the time. Like, can what are the methods? What are the models? How much do studios fundraise, the first round when they're very new studio versus like subsequent rounds. So we'd just love to hear, your thoughts on like studio fundraising, and you covered a lot of this in the book, and I don't expect you, to be able to go into as much detail, but that's why it's very much worth buying the actual book. Like the models are in this book. They are like very well laid out. They are very well detailed. So definitely dive in and actually grab the book. But what did you guys learn about fundraising for a new venture studio?
Yeah, so it obviously varies based on the studio, but when we're talking about a new studio starting out, they would want to raise money at that operating company level to start funding their operations and be able to put that money towards like MVP validation work, et cetera. And what we generally found is, I would say like 10 to 15 million was the most common amount in terms of what studios raised at the outset. And that would last probably for about 5 years. So in the book, when we talk about the base case, it's 10 million for 5 years. Now that can partly include some revenue generation. So like many studios build back. And so that could include the benefits of building back. But if you were to do early exits, that can come down to 5 or even less than that. But yeah, generally I'd say like 10 to 15 was what we saw. Now, that doesn't include a VC fund on the side, which is a very common step that studios are taking now, of raising a separate VC fund to continue to maintain equity ownership in their companies rather than getting diluted. And so that can vary quite widely based on the type of investors you have, like which stage you're in. Anywhere from like 20 to 200 million were the sizes of the funds we talked to. But I'd say for a new studio, you're really focused on that first amount of capital, that 10 to 15-ish million, and you get to the VC fund later. The other dynamic I'll highlight is like, who do you raise from? This was, again, it's definitely a challenge for studios, because to convey what investing in an actual studio means from an asset perspective is difficult. You don't have like guaranteed returns to investors. You may need to promise dividends or things like that. It's quite different than investing in a VC fund. So some of the studios we talked to mentioned how it's pretty challenging to find the right LPs. And generally we saw success when you can find patient LPs, like maybe family offices that are around for the long haul and not necessarily pressuring you to get exits and dividends within 5 years or something like that. And so yeah, there's a lot of dynamics at play here, and there's a lot more in the book, but I'd say that's kind of how we were hearing about fundraising.
And I'll just add one more interesting note on the fundraising front. It's a little bit different than traditional venture capital, where LPs are investing in a fund manager and they're sort of investing around a thesis and the potential capabilities of that fund manager to allocate capital. It seems like from some of the groups that we talk to, when you're investing in a studio, you're investing in the capacity to build startups. And there's sort of this natural proclivity for investors then to say, well, what are you going to build? What are your ideas? And so some studio founders know that. They come in saying, I've been a successful founder before. I have 4 to 5 ideas that I really want to build. I'm doing a studio because I have multiple companies I want to build. I don't want to focus on one. They may or may not decide to pitch those individual concepts to LPs when they're looking to raise capital. So there is sort of this issue where there may be a perceived expectation that studios should have some sort of subset of ideas that the LPs are directly investing in as those companies get built. But the truth is, those ideas are going to pivot. Those ideas may not be the ones 3 months out that actually get worked on by the studio. And there kind of needs to be this movement or push for the studio ecosystem asset class to say, you are investing in us in a very similar capacity to the way you would a fund manager. You are investing around our capabilities as builders and our thesis around what we want to build and how we do it, not necessarily the individual portfolio company concepts we might be trying to bring to market at the outset.
Yeah, I mean, I totally agree with that. I'm curious, do you think LPs and investors in studios are looking more at how the companies are being built or what type of companies are being built? So just kind of are they looking more at methodology and potentially maybe the people behind it, and their capacity to execute? Or are they looking more at the market and looking more towards not necessarily what specific companies do you have, in mind to build? Like, give me your Twitter bio, like, of these companies, but more like, do you have a thesis area? Like, what market and what market research do you have backing up that this is going to be a hot market? Like, which of those two would you say is more important for a venture studio investor?
I mean, right now, I think it's the people, right? They're investing in the people, they're investing in the partners and the founders of the studio, because again, the methodology really is not differentiated enough between studios right now to go to a pool of LPs and say, we build this way as opposed to everyone else, and therefore we will be better. And I don't necessarily know that there's evidence to back that up either. That's one of the things that we initially had kind of looked at in this book, but is an area that needs further exploration in this space. I think they are investing in people who are either proven successful entrepreneurs or have developed some sort of capacity to either build product, or they've proven themselves in terms of venture capital investment. And so they think they'll have a good eye to understanding what concepts can be brought to market. We're seeing a number of studios that are sector and industry agnostic raising money. So I don't even know that necessarily there needs to be a proof point of this is a hot market with strong tailwinds that is going to draw capital in. Right now, I think it's, can you convince as a studio founder LPs of the studio model in and of itself, maybe without even differentiating your methodology? And can you convince them that you are the one who is well positioned to build? And I think those are the two things that are drawing investment into the space.
Yeah, and maybe just to add on what Mitch was saying on sector agnostic. So this was actually an area of surprise, I'd say, for me, is that we only found about half the studios we talked to, which I think is what GSSN in their white paper found too, were specialized. And so when you think about that, and LPs actually putting capital into these studios, they can't really be expecting theses because these studios are pivoting a lot into different sectors based on the market trends and things like that. And so, yeah, plus one to everything Mitch said. And I think maybe one other thing I'll say is there is certainly, at least from what we found, an overlap in LPs between traditional VC and investing in traditional VC funds and studios. So I think part of the challenge is actually when studio leaders go out to raise is educating those LPs on the differences with the studio model, what that means in terms of when you make an investment, you're investing in me as a builder or my team as a builder. You're not going to get exits like as you expect in a VC fund. And so I think part of the challenge is actually more on education and evangelization of the returns in the space.
Absolutely. Anytime I've worked with a studio to help them fundraise, that is always the biggest thing I need to get the studio founders to understand. This is, you're starting an education campaign. This is not you pitching your ideas in your studio. You are literally pitching, like, what is a venture studio? Like, just that, start there. If you can get that past that first hurdle, then you probably have a good shot of actually getting them to hear what else you've got. But you got to get past that, because we really still just, it's not a new space, but it's just very unknown and it's very vague, and people don't, it's confusing. Are you investing in the studio itself? Are you investing in a fund that the studio is a sidecar fund? Like, is it a dual entity? Like, there are a lot of like terminologies and things to kind of get through. So I would encourage all studios that are fundraising currently to get very familiar with explaining these in the simplest terms possible. And the Venture Studios Demystified book does that. I mean, does really, really well at that. There's a lot of definitions in there, a lot lot of simplifications of things and how to kind of just explain things in a very like simple way. And at the end of the day, I mean, you could always just, if you're fundraising, you could always just send your potential LPs a copy of the Venture Studios Demystified book, and they can dive in on their own. But I think all of those like plus ones to both of all of your points, I have yet to hear you say something I disagree with, which just shows how well versed in this space you are. So I would like to end off with a kind of a last question around what are each of your predictions for the future of venture studios? Are they, here to stay? Is the ecosystem growing too fast? Is there going to be a massive consolidation effort? Like, what are your thoughts? Just closing thoughts on each of your predictions. Mitchel, if you want to go first, you can.
Sure. Yeah, I mean, I think the space is going to continue to grow. The economics, when the model is done right, are really, really favorable, both for investors and for the partners who are leading studios. So there's really no reason conceptually from an economics perspective for the space to slow, comparable to traditional venture capital. I mean, we're even seeing traditional venture capital firms getting interested in moving downstream, starting their own studios or becoming LPs in studios themselves. And so venture firms are building up more venture building capacity to get even earlier and sort of leverage their networks and their expertise to build companies themselves. I think that trend is going to ramp up, and you're going to see more established brand name venture capital firms starting to build out venture building programs or more true in-house ideation capacity. As that happens, it's likely that there's going to be more competition as more studios are coming up for what are perceived to be top founders or potentially the most high likelihood of success founders. And that may start to push more favorable equity splits for those individuals. And so we might be seeing ownership for potential founders participating with studios raising and studio equity lowering a little bit. It also probably means there's going to be more opportunity for non-traditional founders, which is something I'm looking into now, and I think we might get into that a little bit later, but I think there's going to be more opportunity for both unconventional EIRs as well as unconventional studio founders to maybe be able to attract capital. And at the end of the day, as the space, I think the studio space might grow a little bit quicker than the LP knowledge and capital allocation will. So it's going to come down to investors are going to need to get smart on what does differentiate a good from a bad studio, and like who are the good founders that we should back. And the good founders, the good studios are going to retain a premium, but it's going to become a little bit riskier as the space grows.
Yeah, I love that. I love those points. Competition definitely is a good thing, especially for underrepresented founders. The more studios, that's why I do what I do. Honestly, the more studios out there, the more founders have a chance at like working with studios. And I think entrepreneurship as a career path is elusive at the moment, and studios make that a very kind of bona fide career path. So I love that, and I agree with you. Actually, double agree with you on traditional venture firms getting into the earlier stages of ideation and beginning to build out in-house studios or studio-like programs. They look like studios, talk like studios, act like studios. A duck is a duck. But love all of that. Thank you so much. And Shilpa, how about you? What are your predictions for the future of venture studios?
Yeah, of course, plus one to everything Mitch said. I think in addition to that, it's really interesting because I think when Mitch and I like probably started our work with the studios, like we didn't find that many people, at least I didn't find that many people in my circle talking about it or familiar with it. And just in the past 2 years, that has increased so much. And so we can literally see the growth in the space, and the increasing amount of education that people are getting access to about studios and understanding it. So I definitely think studios are around to stay. I think beyond the economics that we talked about, that can make a lot of sense. What you both are saying on underrepresented founders is a super important benefit of studios. I also think beyond that, an area I'm personally interested to see how it develops is in areas where there isn't strong entrepreneurial history or a strong entrepreneurial ecosystem already existing, studios can be a powerful way to start that cycle. You give access to, how to be an entrepreneur, how you get on that career path with some capital, and then you start the growth. And so it's really going to be interesting to see how this evolves differently in different places worldwide. I think the other thing I would say is definitely increasing competition as we see more studios. I think at some point what we talked about with capital and access to capital is going to be really critical. And so we might see some maybe like unfair advantages build up in some of the like brand name VCs or studios where they're just able to access more capital and kind of maybe consolidate some of the smaller studios versus like a plethora that we see today. I still think we're pretty far from that point. We're definitely not hitting a place of saturation of ideas or studios or even capital, but I think at some point that access to capital they talked about will become even more important. But yeah, excited to see where studios go. I think worldwide it's going to be an interesting time.
Absolutely. I could not agree with you more. Thank you both so much for coming on the podcast. It's been such a pleasure to speak with you. I will link to your LinkedIn's and the book itself on Amazon and a variety of other places. Is there any other, any other place, where should our audience listeners go to find you, get in touch with you? LinkedIn is the best, or yeah.
LinkedIn is great, and quick plug for a lot of what I'm exploring now is sort of how the venture studio model can be applied to our previous conversation into the social impact space. My background is in working with social impact startups. I think it's an untapped opportunity that's much needed, to Shilpa's point, for bringing entrepreneurship into previously untapped circles, for providing opportunities for underrepresented founders, for building successful companies in an efficient way. For problems that we actually need to tackle in society. I think like the studio model really needs to expand a little bit and it needs to differentiate into maybe some more social focused problems. So if anyone wants to get in touch, talk about that, that's kind of what I'm exploring right now. So you can find me on LinkedIn. Would love to dig in and talk about that further.
Absolutely. It's such a great point. So yes, absolutely. I will link to both of your LinkedIn's, the website where you can buy the book, and highly encourage everyone to go out and get a copy of the Venture Studios Demystified book. It not only is it a fabulous book, but obviously Shilpa and Mitchel put a ton of effort and just, ton of sacrifice, lots of conversations, so much learning. There's financial models in there. I will link to a financial model in the show notes as well. But yeah, so much. Thank you both for coming on the podcast. I very much appreciate it, and I look forward to catching up with you very soon.
Thank you so much.
Awesome. Thank you.